Investing is often made to look complex and dangerous, but it doesn't have to be. Most people think they need to be experts to build wealth, but the secret is actually cutting through the jargon and keeping it simple. Think of it this way. Instead of trying to pick a few individual companies you think will perform well, which is like looking for a needle in a haystack, index fund investing allows you to buy the whole haystack. An index fund is a passive investment. There isn't a manager sitting there trying to outguess the market. Instead, the fund simply invests in every equity or bond within a specific list, like the S&P 500 or the FTSE 100. You're not trying to be an expert, you're just trying to capture the growth of the market as a whole. So, how is your money actually spread out? In most cases, companies are weighted based on their size. This means you get more exposure to the largest companies and less to the smaller ones. These weights change automatically as companies grow or decline. For example, the American stock market currently makes up about 60% of the global market. When you buy a global index fund, roughly 60p of every pound you invest goes into US companies. Within that, Microsoft is so massive that 5p of every pound goes just to them. The beauty of this is that you don't need to analyze every individual company out there. The fund does the balancing for you. Now, we have to talk about risk. Building a portfolio depends on two things: your timeline and your emotional appetite for loss. If you need the money soon, like for a house deposit, taking big risks doesn't make sense. But if you have 10 years or more, you might be comfortable with higher risk for the sake of higher returns. Ask yourself, how would you react if your portfolio dropped 20% in one morning? It's happened before. If you can't cope with that, a 100% stock market portfolio isn't for you. The solution is combining stocks and bonds. Equities or stocks offer higher returns but are more volatile. Bonds provide lower returns but act as a stabilizer to reduce those big ups and downs. Buying both gives you a smoother ride. Everyone wants to know when the right time to invest is. Many people wait for a crash, but that often leads to never starting at all. The most effective strategy is pound cost averaging. This means investing a set amount, like $100 every single month, regardless of whether the market is up or down. When prices are high, your $100 buys fewer shares. When prices drop, that same $100 automatically buys more shares. Over time, this averages out your cost and takes the emotion out of the equation. The golden rule is time in the market, not timing the market. Stay consistent, ignore the short-term news, and stick to the plan. By holding a low-cost global portfolio, you are using diversification and compound interest to build real wealth. Read the full blog at gradragstoriches.co.uk.